class, let's now move on to the LIFO method. If you do not understand the FIFO or haven't looked at the FIFO video, you probably should look at that one first. Look at FIFO first, now we're going to do LIFO. LIFO stands for last in, first out. So let's once again just review the transactions that are going to be taking place. On October 1st, we have beginning inventory of 100 units at 10. Then we purchased 100 units. Then we're selling 150. We're purchasing 100 more. And then we have a sale of 50 units. Remember, we have this journal entry too that takes place whenever we have a sale. When you have a sale, you record your revenue. Well, typically the journal entry is to debit accounts receivable if they haven't paid us, if it's on account. If they paid us, then we would debit cash. That would increase the cash, and we recognize our sales revenue right here. So here's the revenue being credited, whatever the dollar amount for that sales is. But this is not what we're concentrating on in this chapter. What we're concentrating on is not the sale, but the transaction associated with the sale in cost of goods sold and inventory. What happens to cost of goods sold? What happens to inventory? So let's take a look at that. Here is our spreadsheet once again. October 1st, here's our beginning balance, 100 units at $10. We purchased 100 more units at $11. So we've got 100 at 10, 100 at 11. Now, on the 5th, we're selling 150 units. So in our cost of goods sold, the sales column, which ones did we sell? Well, we've got to recognize which method are we using. We're using the last in, first out method. So the last ones in are these right here. So we're selling 100 of those, but we sold more than 100. We sold 150. So then we have to dip into these. So what happened was, let's draw a little line here so we can differentiate. So what happened was we sold the 100 at 11 and the 50 at 10. So there's our transaction right there. Now, let's just take a look at this journal entry, okay? What was the sales price? Well, the problem didn't give us that. I didn't tell you the sales price, but whatever the sales price is, maybe it was $20 a unit or $20 a unit. So you take the 20 times the $150 and record your entry here. Now, with regards to this entry, let's just take a look and see what that answer would be. Well, 50 times 10 is $500, and then 100 times 11 is $1,100. So we've got 1,100 plus 500, so that's $1,600. So what our journal entry would be associated with the sale of this is to recognize 1,600 of cost of goods sold and to recognize a reduction in inventory of 1,600 because these items were in inventory and now they're sold. So we have to take them out of inventory. This balance column is our inventory. So we've got to take it out of inventory, and that's what this is doing. We're crediting inventory, which reduces that asset. Okay. Let's move on now. On the 6th, we purchased 100 more. So let's draw a little line here. Move this line down. Okay, we purchased 100 more at $10.80, so I'm going to put in here 100 at $10.80. Oops, I didn't finish over here. We have left in inventory 50 at 10 because we sold 50 of those, so we still have 50 left. So now, here are those 50 that are still in inventory, they're still assets, and then we purchased 100 more at $10.80. Now, on the 7th, we're selling 50 units. Which units did we sell? Well, last in, first out is telling us we sold these. So we sold just 50 of those, so let's put 50 at $10.80. And what do we have left? Well, we still have 50 of those $10 ones. And we have 50 at the $10.80 ones. So this would be how you would recognize your inventory, your reduction in inventory, and your cost of goods sold expense using the LIFO method. All right, in the next video, we'll show you how to do this using the weighted average or moving average.